The Reserve Bank of India has given its approval for Bharat Financial to be merged with IndusInd Bank 4 months after the two lenders made the announcement. Joining us now to give us a guideline of what the entire process will be completed and what's the recent developments in Bharat Financial as well and the recent results that came out is Mr. MR Rao, the MD and CEO of Bharat Financial. Good having you, Mr. Rao. Thanks so much for joining in. Before I dwell on business at large, and we'll talk about that, just an indication of the timelines for this process, of the merger process?
Yeah, I think now the next two stages of the approval process are SEBI and the NCL, post which I think we will go back to RBI again for final approval. And this should take a few months for the whole thing to get over.
Okay, so about 4 or 5 months would be a good enough estimate, Mr. Rao?
Give or take a month or here or there.
Give or take a month or two, here and there. Okay.
Difficult to predict timelines in a process like this.
Completely understand. Okay, let's move to business. You know, there's obviously in the normal course of business, you do securitize loans, and I think you've picked up the pace out there. Just wanted to understand how is business shaping up? I thought the one aspect that was maybe a temporary hindrance or maybe a temporary red mark, but a mark nevertheless was the increase in the cost to income ratio for you as a company and for probably all of your peers as well. Why has this happened? And is this a process that will normalize itself, or will investors have to by and large live with a higher cost to income ratio for companies such as yours?
No, I think it's at a point in time the cost to income has risen partly because of the expansion and hiring of staff ahead of branch opening.
Mr. Rao, sorry, you were just making a point about how this has just gone up only at this point of time and will probably normalize in the near term. Can you explain that to us?
Yeah, so we've been making our intent quite clear and our plans to investors and the media as well, that over a period of time we ensure that the cost to income comes down to less than 40%. Thanks to our technology intervention in this business, our efficiencies that we are planning, and customer acquisition. So I'm not too worried about this spike in cost to income for this quarter, because over the next 8 to 12 quarters, we will keep getting this down further and further.
Does this happen? I mean, will the normalization happen because of control in costs and because you would have provided a lot of one-time costs upfront, or would it happen because as a factor of the income moving up and the loan growth moving up, and that will essentially bring the ratio down? What do you think works out over the next 12 months?
I think it's a ratio, right? Cost to income. So there will be a lot of factors playing in. The key driving factor would be our singular focus on bringing in efficiencies through technology intervention. So, for example, we were the first MFI to give tablets to our field staff. So we have to get them to, get more efficient in the field. We have plans for customer acquisition based on our growth rates of 30% customer acquisition. We have to ensure that the customer acquisition is very efficient and from the same places that we operate. All this will play out over, as I said, 8 to 12 quarters, and you will see that efficiencies will be the key driver based on technology. Will loan growth, the loan growth by the regular process of growth and so on and so forth will add to the cost to income coming down to less than 1%.
So, okay, let me break this up into two. We've spoken about cost. Let's talk about growth. I heard you mention customer acquisition growth rates of 30%, if I'm not wrong. First, I want to dwell on FY18. Are you on track to get that 40-50% loan book growth in FY18?
Yes, we are confident, as we have been right from the beginning of the year, that we'll meet our guidance for the year, both in terms of the profitability that we set ourselves and as well as the loan.
And how does this picture look like for the first quarter or the first couple of quarters? I mean, does the momentum continue and spill over into FY19 as well? Or is it difficult to predict that right now? We are almost at the end of FY18 in which ways?
No, the way we plan is that we will grow between 40 to 50% year on year, while there is a scope for more growth. we try to peg ourselves into 40-50%. Primarily driven by increase in customer acquisition by about 30%. The increase in loan book growth will come on account of two factors. Increase in customer acquisition by about 30%, and increase in ticket sizes by about 50-20% as customers graduate from one cycle to the other. That's the way we plan. And the customer acquisition is going to be more or less even throughout the year, just as we keep adding more branches and more loan officers. What you see as a customer acquisition in April, let's say, it could be, let's say, X. By December or January, it will be X plus Y because of increase in loan officers, increase in number of branches, and so on. But over the year, we will end up getting a growth of 40-50%. The good thing about this business is there's no seasonality, not much seasonality in this business. So the growth, customer acquisition, everything will be kind of evenly spread throughout the year.
The problem is that on the provisions front, we're not seeing that seasonality. I mean, credit costs have normalized, things are looking up on the disbursements, AUM growth, etc., so on and so forth, but the provisions continue to remain high. What's the reason for the same, and what's your outlook on how provisions will shape up over the course of the next 12 months, or maybe this calendar?
So let me split this into two portions. One is we had the impact on the book on account of post-demonetization. That we have been stating right from the day of demonetization that this is a one-time impact, and it's going to be controlled. We stated that our overall cost on account of demonetization could be 432 crores and be much lower than that. That's point number one. The provisions that you are seeing largely is on account of standard assets provisions that we make of 1%, which is far higher than what we are regulated to. That provision is going up because of our growth in loan. As far as the repayment rate is concerned, because typically provisions has a relation to repayments, all loans that we have given from January 1st, 2017 are clocking a repayment rate of 99.8%. So the business, both in terms of growth and repayment rates, for us, especially for us, Bharat Finance, is back to pre-demonetization level or back to business as usual.
Okay. Last question, really. Almost everybody, Mr. Rao, is talking about how the rising cost of funds will be an impediment for NBFCs by and large. But management after management that I speak to seem to suggest that doesn't, I mean, even the kind of spike in yields that we've seen, and maybe some bit of upticks coming in for the Reserve Bank, but that's a separate story. Just the rise in yields seem to suggest that while the cost of funds optically may go up, NBFCs and large NBFCs will be able to manage it. What's your view here? And if you can explain the how as well.
No, primarily for us, we will do a lot of, actually 30% of our borrowings comprise of securitization and assignment, which is far lower than the normal term loans that we end up taking. And the plan is to do securitization because if the merger goes happens, the entire options. Part of the plan is to do some securitization and assignment. And given that this is a priority sector business for the banks, we don't see any increase in rates impacting our lending rates to our borrowers. In any case, we are operating under the 10% threshold that the RBI has guided us. And we have room to absorb some of the increase in interest rates because we are well within the 10% margin as of now. So we don't see, unless there is a substantial increase in interest rates, we don't see that impacting our business anyway.
Okay, Mr. Rao, you seem fairly confident and I hope it rubs off on the space at large. Thank you so much for taking the time out and joining us and giving us those perspectives.